My name is Peter Renton. I am one of the organisers of this event, and I'm here because this is one of my favourite topics. I think that the whole idea of payroll data, payroll connections, it is undervalued in fintech, and I'm one of those people who thinks that this should be commonplace for everybody. So anyway, I got to get my stuff together. It's just been go. Here we go. All right, I'm doing introductions here. We are going to start with Jordan down the end. Jordan Wright is the co-founder and CEO of Atomic. Atomic builds payroll connectivity to help the most financially vulnerable people in society. Its customers include many of the largest neobanks, fintechs, as well as many traditional financial institutions, including 2 of the top 5 largest banks in the US. Next to Jordan, we have Shmulik Fishman. Shmulik is the co-founder and CEO of Argyle, the leading platform for consumer-permissioned payroll connectivity, which gives businesses fast, cost-effective access to real-time income and employment data. Founded in 2018, Argyle's coverage of US consumers is superior to the 3 largest credit bureaus and delivers hit rates up to 5 times higher than all the other data providers at a fraction of the cost. We have, next to him, we have Kirill Klokov, is that right?
That's right.
Okay, good. He's the co-founder and CEO of Truve. Kirill attended Stanford Business School for his MBA before going on to successfully lead product organizations at EasyHome, Trust Wallet, and Carter. As he thought of the idea for Truve, he recalled his experience with the financial system in the US regarding his inability to get approved for a loan, even with a great job and an amazing education, because he had a 520 credit score. Over the past 3 years, Kirill has been building Truve with the mission of putting data back into the hands of consumers. And anyway, that's a little bit of background on everybody. Let's just get right into it. Shmulik, I want to start with you and talk about what do we mean exactly by payroll connectivity?
Sure. Well, first of all, thanks for having us here. It's good to be talking with you and on this panel. I break this down into it's 2 words, so let's break it down. Payroll, we probably all use payroll. You've been paid by payroll. Connectivity, connecting into it. Payroll for most of financial services is offline. In order to get payroll data, you need to download something, look at a piece of paper, review it by hand or manually. And so adding the word connectivity into it means that we're making payroll programmatic, or that we're bringing payroll onto the internet. And that opens up a ton of new functionality where instead of trying to ask for pay stubs, instead of sending social security numbers around the internet, you can have somebody connect to their payroll and then review that payroll information.
Okay, so then let's talk about the how we are able to advance financial inclusion. Maybe, Kirill, you can kind of give us that use case of what is it, how is it helping?
Okay, let me go back first to my experience when I tried to get that loan that you mentioned.
Sure.
It was a horrible experience, and it came down to me trading pay stubs back and forth with the lender, and then they give me a 15% APR loan to get a car. And in reality, 1 out of 3 Americans today, 45 million people that are working today, they have exactly the same experience. And the challenge is not that it has anything to do with me. I just had like a pretty bad credit, or anything to do with the lender. It has to do with the tools. And if you don't have the right tools to underwrite the consumer, understand them at a deep level, you just tell them no. And 1 out of 3 consumers actually will just be rejected right away and go get a payday loan. So payroll connectivity allows you to first understand consumer, how much money they're making, how they're deducting their, where the money goes from their paycheck. And if you can underwrite the consumer, you can also deduct money directly from the paycheck. As a result, you lower the risk as a lender, and you can reduce the fraud, and you can reduce the default risks as well.
Peter, can I add to that?
Sure.
So one of the things I will say is that traditionally, this data sits inside of all these payroll systems. But these payroll systems charge typically such large fees to access that data that it blocks out essentially anything other than a mortgage because of the cost that a mortgage goes through and the money that's made off of a mortgage. You have groups out there that charge $30 to $50 to be able to access employment information. And I think that's part of what all of us are trying to fight against. And for financial inclusion, anybody should be able to access their own data, which is, it is their own data, and they can't access it because it's paywalled. And that's a critical thing that needs to change that I think all of us want to have changed.
Perhaps there's no love lost in the sponsor of this room. I think the logo that we're staring at, we're talking about as well.
Okay, let's move on from that. Okay, I didn't know we were gonna get the knives out. Okay, so what are the primary use cases then for payroll data? Anyone can jump in.
Yeah, I think Jordan makes a good point, which is payroll data historically has been used to underwrite mortgages. That's where it has the sort of highest use, where people are reviewing pay stubs that go back 1 or 2 years to underwrite an asset that is sometimes $500,000, million, $2 million. And once you start thinking about that, you're able to spend $100 or $200 in data fees because the ticket of the purchase is that high. And the issue is that everybody needs income data all the way down to daily cash advances. You want to make sure somebody's making that money. Auto dealers, loans, term loans, these are all products that require income data to know repayment. It's just that the big red company charges very high rates, which keeps it out of reach of most products. But the truth is the data is inside of payroll, and if the consumer themselves is the one that is accessing it, it's free, or it doesn't have the same sort of price tags on top of it.
Yeah, I'll add, Peter, just another piece of, we do a lot of direct deposit switching. So it's another use case that is enabled through solutions like this, is allowing consumers to change their banking relationships. The CFPB came out, I want to say in 2021, and said that one of their main goals is decreasing the friction of people changing financial institutions. And we've seen some of this in Europe already, and some things that have been taking place. And so our sorts of companies have the ability to be able to enable that frictionless experience. Potentially, it's still fraught with friction. You know, you have to change all your payments over as well as your paycheck, and there's so many other things that have to go into it. But there's a lot of things that can be done there in that space to be able to simplify and make it easier for people to change their banking relationships. That's another use case for it.
Right. Let's talk about lending, because that's one of the things I think I'm really interested in, because when you're, maybe what we could do is just explain how does it actually work when you're working with a lender? What's the process?
Yeah, I can talk about it.
Yeah.
Well, it's a B2B2C play. So we sell to lenders, and lenders then reach out to the consumer. You can do it through a POS, LOS system, or your homegrown system. You show consumer the interface, and the first thing, the point of friction, is for the consumer to find their employer, or actually an organization that pays them. And a lot of times when we talk about connectivity, we talk about payroll, and I think this panel is called payroll. But in reality, payroll is just a small fraction of how consumers get paid today. They get paid through payroll, they get paid through enterprise platforms like Walmart has homegrown, they get benefits, they are self-employed, they're unemployed. So first is consumer has to find the organization that pays them. Then they are able to log into that organization through an interface, and then on the back end, we'll log in as them, extract that data, and return data through a secure API back to the lender that needs that data. So all in all, that process can take 30 seconds. And yes, we were talking about the instant databases. Actually, this process can be additive. It can be in front of instant database or after instant database, and improve coverage and improve conversion. So all in all, the value for the lender is that you reduce fraud, you increase your automation and coverage, and it actually reduce CAC, because nobody wants to wait for 3 days to verify their employment.
So what types of lenders are using this today? Shmulik, do you want to give a...
So I'm super interested right now in regional banks and credit unions. In so many ways, smaller financial institutions have been left behind and enjoyed less technological innovation over the last period. And many credit unions still ask in emails, on phone calls, with fax machines, no joke, for people's pay stubs. And the ability to arm regional banks and credit unions with tools, lightweight tools, where they can send an invitation to a borrower to connect to their employer. And from that single interaction point, they're able to get data back inside of their own system on how much somebody is paid, how often, by whom, what type of pay is it, what's their base pay, what's their job title, these basic pieces of information that they've been used to getting. I think that that's the real unlock. It's really easy to think about the use case of I'm inside of a neobank, right, and I've clicked a bunch of buttons and I'm inside of a very digital experience. But keep in mind, there's so many experiences in the financial system today that are still quite manual, and bringing those into the digital realm, I think is a big gain for everybody and definitely increases financial inclusion.
So how does a lender incorporate this type of data into their underwriting model?
Yeah, I would say that it's not that it's incorporating this data, because the data that we're talking about, the data about job title and base pay, this is data that all lenders use today. It's just that this data might be coming to a lender manually, might be coming to a lender through a very expensive credit bureau. It might be being keyed in from some other system where there's a copy and paste. What we're discussing is having this data arrive programmatically, directly from the source, without all these other intermediaries that are usually a part of capturing this data.
So then what are lenders, because this is still a fairly nascent industry. There's not every, I mean, every lender uses payroll data, right? But not every lender is directly connecting into
That's right.
payroll data. So what are the lenders that are not doing that? Why aren't they doing that?
Go ahead, Grill.
I think they're doing it the old way. The credit box, especially in an environment like this where interest rates go up, credit box get shrunk, and as a result, everybody's competing for the same consumers. But if you think about the market opportunity that the consumers that you tell no, have you been able to verify them? And Jordan was right, like if you go to an instant database, it's so expensive, then you might not be able to economically do it. But if you go to the right tool, like payroll connectivity, cash flow underwriting, the instant document processing, as a lender, you would be able to underwrite those consumers. And I think once we realize that there's a huge market there that lenders are not serving today, and if you look outside of your small credit box, there's a huge market that is waiting for you to be, for them to be served. At the same time, they're also the most loyal customers you would get, because the alternative for them is usually a beta loan. And that's why I think the inclusivity is really important, not only from the perspective of like society, but also it's a good business to be in.
Yeah, Peter, I would add to that just, right now, since you can verify this information seamlessly with like last four of a social, first name, last name, with some of the larger groups out there that can verify it instantly because they have connections built into ADP and things like that, right? So that data is being utilized because it's easy to get. That doesn't take authentication, which our solutions rely on, authentication. And so then when you go down market from those mortgages where their verification of income is priced into mortgages, when you go down market, that's where the big opportunity is for people to start using this data. But then they say, which is better, a credit score or being able to verify this information? And some of them say, a credit score is just fine, right? We've seen, as the market deteriorates, we've seen a lot of people come to us and say, we don't want to slow down our lending, so we're going to have to get more data points in order to improve the quality of our lending as market turns, right? And so I don't know what lies instead ahead of the U.S. economy, but I think there are some issues that having payroll data or being able to receive payment directly from a payroll system or other sorts of things help reduce risk in a way that allows that group to be able to say, we're going to do this loan at a very similar rate or maybe just slightly higher than we would have before, even though we can't, because we're getting more data than we were before. I think that we'll see some of it there. But I mean, a credit score I can pull like that. And so having to be able to authenticate is a key problem that we do face, even though we do see a lot of people doing it. Right.
So I want to go back to the financial inclusion piece, because I think this is the thing that's most exciting here. And, you know, you've got, you know, and let's maybe just pause for a second and say, most of the lenders using this, or maybe you can verify this, the way I understand it is you are getting, the reason you're able to really provide, or lender is able to provide better pricing is because they're getting paid directly from payroll, right? They're not waiting for the payroll to hit the checking account.
That's a fraction, I would say, still of how it
It
works
is?
today. Yeah, I mean, so I think across all of our companies, I would say that that's true, that people are getting better quality data to be able to potentially underwrite with, right? You can get more data than you have in the past. You're getting it for loans maybe you didn't in the past in a different way, in a secure way that's not potentially fraudulent because you don't get a picture of a pay stub, right? But we do, I mean, you guys can speak for your businesses too, but I would say, gosh, maybe 25% of our business where people are getting our information for verifying income for a loan are also using that same connection to make a payment. Maybe it's less than that. I don't know how that is for everybody else.
I'll say it this way. I think what's so exciting about all these services in the long run is that there is a bidirectional connection where you can pull data out and put data in. And I do think that most lending works as such, where first you need to request data on a data subject or on somebody that's looking for a loan. You analyze, you give them the loan, and then you want repayment. And it's at that time of repayment that you can find the source. Where is the source of this repayment? Historically, it has been with banks. But what you can do is set up repayment inside of Payroll, where there is an allocation, either a fixed amount or percentage of your monthly pay that is segmented directly back to repay the loan. We're making this easy because we can both read and write into a payroll system. But I always like to remind people, you can do this manually the hard way today as well, and there are many lenders that do, which is very arduous.
Right. So Kirill, going back to you with the 520 FICO score, are we making a dent in that population with this product, or is there other things that are needed?
I think we definitely do. It's still early. If you look at our companies, we've not been around for even 5 years.
Right.
And I think the population that really needs that, lenders have to catch up. And for lenders, when 2021 the market was growing so fast, all you had to do is just do more leads. But now the market had become tricky. And as a result, as a lender, you have to become way more crafty, and you have to look at new data sources. And that's where I think our businesses are really helpful in understanding the consumer in a different way. Mm-hmm. And as a result, you can unlock that market that has been sitting there. Nobody was really paying attention, but now it's out there where consumers really need you to help them get the right type of loans.
Right. So I just want to talk about fraud just for a second, because there's places you can Google fake pay stubs and find a very, very convincing pay stub that you can use.
We even have a game on it here at Fintech Nexus. If you come by our booth, we have a game where you can try to detect, is it a real pay stub or is it a fake one?
Oh, really? Oh, okay. That's interesting. So how is it, you're connecting directly into payroll systems, right? So I imagine fraud is really, really negligible. Is that true? Or tell me a little bit about how you're catching fraud.
I would go as far as say it does not exist, because for a fraudster to get a job, talk to HR would submit I-9 form, then you would have to get paid for preferably 4 or 5 times. It's too much work.
Right.
So the fraud almost does not exist, and that's why one of the benefits of getting the data directly from the source comparing to pay stubs. Pay stub, also those systems, there are systems for $8.99, but you can also get a very good looking pay stub for $200 that we tried with all the OCR systems that are out there. They couldn't catch it.
Interesting.
Fraud is always a conversation that needs to be had in a lending business, and I think rightly so. The other half, let's give some borrowers a little bit of easing. There's a lot of mistakes that are made, not because of fraud, but just because of clerical errors. Lending is, for all of its glory, rather manual still. And that means that people are reviewing documents and manually copying information and putting it into a system. this produces errors.
Right.
And part of what sometimes shows up as fraud is sometimes just clerical errors. So I think you're getting rid of two things here which have plagued the industry. One is, yes, people making up fake information. The other is the enormous amount of information that is inside of credit decisions that are just wrong, that are errors, that are clerical mistypes.
Right, okay. So we're out of time, but I want to do a little lightning round. What's it going to take to get every lender on board with payroll connections? Kirill, why don't you start and we can just go down the line.
I think it's just realization that there is a huge business out there that is not being served, and the population that could potentially be very loyal, that needs you, and if you use the right tools, you would be able to capture that population.
Smiley?
Time. It's just going to take some time.
Okay. Jordan, you have the last word.
It depends on use case. It won't happen for some use cases.
Right. Okay, well, thank you very much. Give them all a hand, everybody. Thank you.
Thank you.
Thank you.